say we get started.
All right, let's do it.
Right. Good morning, everyone. Welcome to Francis Financial's third quarter market roundup. And we're your experts on this webinar today, Paul Stages and Avni Ramnani, that is me. Paul is our senior advisor. You see all that alphabet soup next to his name. It just means that he is very learned. He's got a lot of certifications under his belt. He's an expert in the area of financial planning, divorce financial planning, and private wealth management. He also has, 9 years of work experience now, and is absolutely phenomenal when working with clients.
Thank you, Avni.
Thank you for.
I've learned everything from you, and you're not a slacker yourself with CFP, CDFA, and so for those of you who don't know, Avni Ramnani, our director of financial planning and wealth management, and we're happy to be here with you this morning.
Yes. And we'll do a quick market review. So, Paul, do you want to get us started with that?
Sure. And I do want to mention before we jump into things, a reminder that we do welcome questions throughout the presentation. So if we're not able to get to them immediately, we do have some time dedicated at the end. So we'll be talking about how the market's performed over the last 3 months. We'll talk about headlines that are in the news and that might be relevant to our clients and to their portfolios. We'll talk about what smart investors should be doing during these times. And then we'll wrap things up discussing some exciting events that we'll be hosting over the coming weeks and months, and then as well as get to some questions at the end if there are any. So without further ado,
I'm sorry. Feel free to put your questions as they come along in the chat box, in the Q&A box, whatever works for you. I have everything open. So yeah, let's get started.
Sure. Jumping into things, as I mentioned, we'll first talk about how the investment markets did in the third quarter of the year. And in a nutshell, they did very well. It was especially a strong quarter for stock investors. You'll see these green arrows here, which indicate that most major investment markets posted gains for the quarter. And to clarify, the third quarter was July, August, and September. And you'll see US stocks and emerging market stocks really led the way. They were up almost double digits, which for 3 months is phenomenal returns. International developed stocks were up almost 5%, which is also very strong. And even US bond investors were rewarded with almost a 1% return during a time that many investors felt comfortable taking on risk and moving money into equities. So across the board, we saw positive returns. So what led to this upswing? Well, essentially, the economy continued to come out of the lows that we saw back in March, as many of the worst fears over COVID-19 failed to materialize. And COVID-19's effect on the economy, at least during these summer months. That allowed the S&P 500, which is what we're seeing here and is a good proxy for the US stock market, to make its quickest recovery from a bear market in history. You'll see this chart here where the relative lows were reached on March 23rd. So we were definitely deep into a very quick bear market. And then very quickly, we've seen a recovery out of it to the point where new record highs were hit in September. And the S&P 500 has returned over 5% for the year as of the end of September. So really quick turnaround there. We'll come back to this slide in a moment. But to look at how non-US stocks performed, they also did very well. You'll see here a list of countries and how each of them and each of their stock markets performed during the last 3 months. But the lighter green, that is the global composite. And so that index rose over 8% in the third quarter, and putting the global index up almost 2%, positive 2% on the year. The reasoning, similar to what drove the US stock market back up, is that economies started to open, consumers were spending more than they were back in the springtime. There was more optimism of, again, not having the worst fears come to fruition, at least during these time frames. And so that drove up global stocks. So what else do we know as of now? If we go back to this slide here, what this slide is showing us, there's a lot going on, and so I'll try to explain it here, is that investors are currently paying a premium to hold US stocks. So why we say that is, on average, for every $1 of earnings per share that a company in the S&P 500, so we're talking the 500 largest public companies that trade on the stock market, for every $1 of earnings per share that a company in the S&P 500 reports, investors are paying over 20 times that in price per share. And you can see that it's actually about 21.5% as of the end of September, where the average over the last 25 years has been closer to 16 and a half. And this is that commonly cited PE ratio, which shows that you can make an argument that right now US stocks are overpriced, at least historically speaking. If we look at the non-US stock counterparts, what these charts are showing is a comparison of how emerging market stocks, which are on the left, how their prices compare to that of US stocks, and emerging market stocks by some metrics are priced at half the price of US stocks. And with emerging markets, that's Latin America, that's African economies, that's China, India, where developed markets, that's Canada, Western Europe, Japan, Australia, they're also trading at a discount compared to US stocks at about 80%. So 20% cheaper than US stocks. Emerging market stocks are 50% cheaper. So what this tells us is investors might be willing to pay a premium right now for the perceived safety of US stocks. It could also reflect that the US, coming into COVID-19, because we were seeing some similar dynamics going on coming into 2020, the US economy had progressed at a greater clip than did most global economies coming out of the Great Recession from over 10 years ago. And so that's raised stock prices here domestically compared to those that are abroad. And so we see that reflected in this chart here, where when we look further out, looking at what's happened in the last 1 year, 5 years, 10 years, we do see US stocks leading the way. We also see emerging market stocks having performed well over the last 1 year, as well as the last 5 years. We've seen the US bond market also perform well. So the thing to really take away from this slide, as these numbers will change on any given day that you're looking at them, the thing to note about this table is the variance of returns, the difference in the different asset classes in the different time frames. And so this is evidence of diversification at play. And it's the reason why diversified portfolios are very important, is because asset classes don't move in lockstep with one another, and they definitely don't do so over shorter periods of time. And so it's evidence here that we do see that variance in returns. So with that, we'll throw it over to Avni to discuss what we're seeing now and what we might expect in the near future.
Yes, thank you. Um, so every quarter we want to just go over the news, the headlines, and see what's been affecting the markets. And this year it's been all around the coronavirus, the COVID-19 pandemic. What we've seen as cases reach new highs. Um, Paul, can we move to the next slide, please?
Hmm.
Thank you. Uh, U.S. cases are really surging, but so are cases in Europe. In fact, now on a per million basis, so if you adjust for population, Europe is reporting 187 per million people, whereas the U.S. is 162 per million people. So, again, even in the US, there is a second or third wave coming. Cases this fall, we've already seen on the upper Midwest, cases in the fall coming in. Even I think at this point, it's just a little bit of an exhaustion from social distancing, and people are throwing caution to the wind and congregating, which is what is causing all these issues. We've got cell phone data that's showing decreased social distancing, um, and it's a big concern. So let's see where the rest of the fall and winter bring us. There are many experts out there saying that these cases will increase as people spend more time indoors in the fall and winter months. So we'll see how that impacts the market. We can say one thing we can say is because of these uncertainties, we're looking at a volatile market coming up. Next slide, please. The other thing that's impacting just the news cycle and the world in general is the coming up U.S. election. Of course, there are lots of polls out there that are predicting the outcome. It looks like right now, based on the Guardian poll, that the Biden presidency might actually happen, and it's leading the Trump campaign by about 10%. So we're looking at a Biden-Harris White House, and let's see where things finally land, but that's the prediction on the cards. Now, what does that mean? It means that come tax time, there might be some implications. Well, not come tax time for 2020, which is as of now, April 15, 2021 filing. But Biden-Harris campaign has released a 110-page policy document giving all kinds of guidance on where they want to take the tax policies. Essentially, it's just rolling back everything that all the changes that the Trump administration had made, increasing individual tax rates, the highest tax rate, capital gains taxes, making those changes or rolling back those changes. Estate taxes, there are a few changes that are being proposed right now that will close some loopholes and also increase taxes overall. And then corporate taxes going back up from 21% to 28% with a 15% minimum tax on corporations that have there we go. So yeah, the capital gains taxes are coming back up, the highest rate going back to 39.6%. There's going to be no step up in cost basis for heirs under the Biden proposal, so that's closing a loophole. And then the next piece is the corporate taxes with the rates going back up and a 15% minimum for large corporations. And the next, how does that impact what's going on with the U.S. economy? Um, unemployment rates are decreasing compared to where we saw them back in March and April. These are, of course, new claims. So a lot of the claims have already happened. People are already on unemployment, and the newer claims are reducing, which essentially means that the job situation in the market is somewhat steady. Doesn't mean that a lot of jobs are coming back. Some definitely are, but newer claims have reduced quite a bit since the surge we saw in spring. Um, the stimulus bill, well, it's highly unlikely that that's going to pass before the elections. And there's been a lot of back and forth negotiations on this bill, but once the election happens, and if there is a Biden presidency, we do see, well, depending on the Senate and the House, it seems that that stimulus bill might get passed at that time, soon after the election results. So what does that mean for the markets? It means a pretty volatile 6 to 12 months. Given there might be an uptick in the virus, we might see some additional close downs that could lead to higher job loss claims. And, with the stimulus package not being finalized, there is some uncertainty around that. So be prepared for ups and downs coming up in the market, and just, go along for the roller coaster ride. Next up, we will talk a little bit about what does it mean and how do we smartly invest through these times. So, Paul, if you want to tackle that.
Yeah, you're leaving me with the easy part, right? You present all of these
Yes.
uncertainties. If a pandemic wasn't enough, we also have this election year, which is always brings some choppiness to the markets. But the good news is that as smart investors, the solution is relatively easy, and that is to stay invested, to stay disciplined, and have that diversified portfolio that I was referencing before, and really tying it to your own financial plan, to your own financial goals and your own risk tolerance. Because what the data has shown us is that there's no compelling case to be made that under a Republican administration, that's when you need to really put your money in the market and have it work for you, or it's only under a Democratic administration that you should really be investing. That's not the case in either one. So, if we take a very extreme example and look at if you were an investor 120 years ago, January of 1900, and you were putting in your $10,000, which at the time that would be no small fortune, um, and you were looking to only invest in years where there was a Republican president, that 10,000 in 120 years would have grown to only $100,000, which will tell you is not a very good return over that many decades. Similarly, if you're only going to put your money into the market under Democratic administrations, your 10,000 would have grown by more. I believe there have been more years where there have been Democratic presidents. That 10,000 would have grown to 430,000. Still, not that great of a return when you compare it to what would have happened if you just kept your money invested the entire time, making sure that yes, you were invested even during the Great Depression under this example, but your money would have grown from 10,000 to over $4.2 million. So this is an extreme example, but it's here to show that what we see on the next slide of there are ups and downs throughout each and every different type of administration. When we do see a change from blue to red or red to blue, there's no compelling evidence to say that one thing will happen over the other. Really, during any sort of stock market up or down. It's usually that there's something going on in the economic landscape. There's something going on with consumer spending, with production, with wars, perhaps things like that. That those have a direct effect. But what we see over time is that long-term investors win out. And so to do another kind of exercise of if you had invested $100 in the US stock market almost 100 years ago, that would have grown to $100,000 just by staying invested. If you had taken it out at any point, you risk missing out on those up days, which really do add up. And there are more up days, positive years, positive decades, than there are negative ones, which is shown on this next slide, where I talked about it before that 2020 we've seen a bear market, which is when the stock market drops about 20% from its most recent high, and we might be seeing the beginning of another bull market. So interestingly, I didn't realize it was so even until we saw these statistics that the S&P 500, so again here the U.S. stock market, going back almost 100 years, has experienced the same amount of bear markets when the market drops, and you see that represented by this almost mustardy yellow color. There have been 17 bear markets compared to their counterparts, which is the bull market. So if you just heard that there's 17 bear markets, 17 bull markets, you'd almost think, okay, so then investing is a zero-sum game. I almost have to get lucky and then just take my chips out and go home. But the reality is that bear markets on average their decline ranges from negative 21% to negative 80%. And really that 80% only happened once, and that was during the Great Depression. During the financial crisis, it was 50%. During in March, because of COVID, it went down 23%. So it's scary to be an investor during that time frame. We don't want to diminish that by any means. But what we then see is that bull markets, when they inevitably follow these bear markets, they advance the stock market up ranging from 21% to 936%. And not only that, they also last almost 6 times as long on average as do bear markets. And so these bull markets, they're shown by this teal color, and you can just see the visualization here that what happens is when you view it together, it's again staying invested. It's those long-term disciplined investors that in the end win out because they don't panic, they don't pull their money out when the bear market is happening. They stay invested, roll with the punches. So long as you have diversification, you have bonds in your portfolio, you have some non-US stocks as well, and you're able to get through those times to then reap the benefits of these longer lasting bull markets. So I hope we've ended on a positive note given all the uncertainty and all the headlines in the news. So I don't know, Avni, do we have any questions right now?
We don't have any questions so far. I think we've done an excellent job of explaining everything. But if there are any questions, please do feel free to reach out to us. We're happy to chat, happy to connect over email. We do want to share about a special event coming up, the Money Conversation Circle. The topic on Thursday, December 3rd is socially conscious investing. And the event is from 6:30 p.m. to 8 p.m. We bring together a group of 15 to 20 women and just talk about different topics about money. This is a amazing event. We just had one last week, and it really gives you an opportunity to come together and discuss what your thoughts are on different things around money. And the socially conscious investing is a special topic that's close to all our hearts. So we hope you can join us. Please RSVP there to clientrelations@francisfinancial.com, or you can email any one of us, and we're happy to help you. We also have some fitness and physical movement classes. On October 29th, we have yoga with our very own Deborah Donenfeld. On November 5th, we have Strength and Tone with Dr. Laura Miranda. She's amazing. And then again on November 12th, we have yoga with Deborah Donenfeld. So every other Thursday at 5:30 p.m. for 30 minutes, we either do yoga or a strengthen and tone workout. Please look at that Zoom link, or you can ask us, and we're happy to send it to you by email. Thank you very much. I do have a question, Paul. I have a bond stock or fund. I've been so focused on receiving high dividends, but not enough on stock price. They've lost a lot of value. So is it better sometimes to cut your loss and take the hit or unrealized gains, or hold on to keep the portfolio diversified? It's a great question. There are times when you don't look at the total return, what the stock price or the fund price is doing versus the dividends and the interest that it's throwing out, or the income that it's throwing out. So depending on what role it's playing in your portfolio, and depending on what other things you have in your portfolio, it might be a good time to do that reevaluation. Just on its own, it's difficult to answer whether this fund might come back, what the future prospects are. But if you feel like this fund is not coming back up, then it might be a good time to cut your losses. You might also have gains built into your portfolio from from another fund or stock. So if you want to sell out of the gains, again, it might be a good time to do that. So you sell out of the gain, you sell out of the loss, and then from a tax perspective, you land at a neutral spot, or as best as you can at a neutral spot. So yes, it does look like this might be a time to reevaluate your portfolio in general. Folks, please send us your questions if you have any. This is all the time we have for the webinar today. And do let us know, reach out to us if you want to participate in any upcoming events or have any questions. We're happy to help. Thank you very much, and we look forward to hearing from you.
Take care, everyone.
Bye-bye.